Welcome to the Broken Pie Chart Podcast, episode 141. I'm your host, Derek Moore, and with me this week is my usual semi-permanent co-host, CEO of ZEGA Financial, Jay Pestrichelli. Jay, how you doing today?
Hey, Derek. Doing well. We're recording this on a Friday, and it's a Friday I was looking forward to. Ready for the weekend, my friend.
Yeah, I feel like there's been a lot of stuff going on in the markets recently. It's been busier, after a lot of a really benign summer. And by the way, I know you were doing a little traveling this week. I think you missed the big. Did you see the Nassim Talib, the big news on CNBC?
I think I caught the tail end of it. No pun intended. In my hotel room. I can't remember where I was, but I remember seeing him on TV. I do like to watch him speak. Really intelligent guy. I think he's probably better not in a TV interview, but he does have a lot of interesting insights when it comes to managing risk.
Let's get into what he said because I think it's worth talking about. So he called Bitcoin a bubble without aesthetics, and I'll read his tweet. He said, "Let me repeat it to those unable to get it. I'm not bearish on Bitcoin. It is a tulip bubble without the aesthetics and disguised as a currency. Hence, it is as irrational to buy as it is to short, perhaps even more." Now, he, of course, is the author of the Black Swan book. And, look, I mean, I have, I won't call them disagreements. I have different opinions than him on some stuff. I've been a little bit more of a Bitcoin skeptic, but calling it a bubble, the tulip bubble, I mean, in our industry, that's about as bubble-ish as you could get, right?
Yeah, I mean, I think for those of you that don't know what the tulip story is, was it the 1700s and it was the price that people were
1400s, I
willing.
think. 14 to
1400s. Okay.
15s. Yeah, Dutch, right?
It was a long time ago before both of us were born. I know we're old, but not even close to that old. And it was right. It was the price that people were willing to pay for tulip bulbs, so that their property could look nice. I guess is it the Dutch? Is it Denmark? Where do they love the tulips? Now I'm embarrassed. I don't know where.
No, it was Dutch because they were guilders. It was priced in guilders, which is Dutch, I believe.
Yeah, but where
So
is
no,
the
that's right.
Dutch? Where are the Dutch? Right? Isn't that's the Netherlands? Right? The Dutch are Netherlands.
Correct.
Yeah. Okay. I should know that because I go to a Netherlands province every year down in the Caribbean. So right, the Dutch. Got it. So anyway, there was this huge spike in prices on tulip bulbs, and it immediately crashed when people started realizing that tulip bulbs shouldn't cost as much as what you spend on food for the year, right? Those kinds of things. So that is kind of the quintessential bubble that everybody always compares to as the most irrational bubble. And I think Talib's comments are saying it's just as irrational as the tulip bubble. Is that what he's saying here?
Yeah, no, I think that's right. I mean, he basically says it's. I don't want to misquote him, but I feel like in the past he's called it a little bit of a fraud, a giant Ponzi scheme, and the tulip bubble. Definitely recently it's been the tulip bubble. I mean, okay. So here's where I definitely agree with him, and I want to separate. There's two different things between what Bitcoin is and isn't, and there's the question: is it a currency? And then secondarily, is it just an asset? And then thirdly, that's not really a word. Third, is price irrational? Like, so I think in the first point, Jay, I agree with him. I mean, I think it's not really a currency.
It's not a currency. I agree too. You're right. I don't think it's a currency either. I mean, yes, you can pay for things with it, but it's the El Salvadorian government is telling you it's a currency. I don't think it's proven itself to be a currency yet.
I mean, in a currency, right? It just you have to have a medium exchange. I mean, the whole idea with currencies, we've talked about this before, is they solve the problem of, hey, let me drag this boulder of a piece of gold around and go walk 2 miles to get a loaf of bread. I'm going to chip off a little bit of the piece of gold to pay for the bread. Currencies, but it's not a currency in my mind because number one, and he makes this point, you still have to convert it into something else. And he makes the point further. He said, if Bitcoin's a currency, why isn't Apple stock a currency? And meaning, hey, if I have Apple stock, it's not like I can pay for things in Apple stock. I have to sell my Apple stock first and then go into it. So, I mean, I think he's right there. And I think it's,
I'm going to push just a little back on you there, only because there are some companies that now will accept cryptocurrency as a means of payment for their services and their goods. There's not a lot of them, right? But there's some of them that will take a cryptocurrency as a means of compensation, and Bitcoin is obviously a cryptocurrency. So I think generally speaking, you're absolutely right. And your loaf of bread example is great, right? Because if Bitcoin drops in half, you don't have to pay half as much for a loaf of bread. It's still denominated in dollars, right? So yes, I think in general you're right, but there are some scenarios, Derek, where you don't have to convert it and you can purchase something from a company using Bitcoin. But that's on a company by company basis, right? That's just their choice, right? I think what professional baseball team said they'll now allow you to buy season tickets with Bitcoin. Might have been the Astros. I don't know if that had anything to do with the with the World Series, but I do. So I do think there are ways that you can do that.
okay. So, but does that make the tokens at Dave and Buster's a currency? I take my son there, I put my dollars in the machine, and then I have these tokens. So does that mean that I could take those tokens and now it's a currency? Those aren't a currency.
They're not. They don't have any value except at Dave and Buster's, I guess, and you could do something. But if you could buy a Tesla with Bitcoin, you have a car when you're done, right? So I don't know, right? If I bought two Bitcoins a few years ago and now it's worth $120,000, I could give them my two Bitcoins and they'll give me a car.
All right. So then the other point he made was about volatility. And I think this is an important thing to discuss. By the way, before I lose the train of thought, I always think of Holland when I think of the Dutch, but it's part of the Netherlands, right? We do have listeners in that part of the world. So
I know, and no offense to anybody there, but I think we got it right. We did say the Netherlands.
they do have a heck of a foot, I'll say football, but soccer team, by the way. Anyway, the three people who are listening have just all tuned off. So let's quickly
Don't
transition
leave.
back to
Correct
Bitcoin.
us. Send Derek an email. He wants to hear from you.
But the volatility, and I think his point on volatility, like how could you actually like go buy a car and feel good about it, and then it's up 50% from the Bitcoin that you just spent, or vice versa. And I think that's the thing too. I mean, there's just too much volatility for you to actually, okay, I'm going to keep my life savings in Bitcoin, regardless of whether it's going up or down, because it's stable and there's too much volatility in it.
No doubt about it. I haven't seen an asset class with more volatility than crypto and Bitcoin in particular. You're absolutely right about this. It's very volatile. It's not stable. I think it's a reason why it's not a reliable form of capital transactions.
Yeah, I mean, the other point he made. So here's the thing too. I would say, in my mind, it's not really a currency, and I just think it's an asset, and and I say asset in quotes because Beanie Babies are an asset, and baseball cards were an asset, and certainly those went through bubbles. I'm not saying I don't have an opinion necessarily on the price of Bitcoin or anything else. As you and I have talked about, I own, and so do you, very small percent of my overall portfolio in those. But I just think it's, to say it's a currency. I mean, it's just like anything else. It'll go up if more marginal buyers come in than sellers. And if more people sell than buy, it goes down. Where I think it gets interesting, though, is this idea, and here's I'll push back again, that it's something of a hedge, and he made this point as well. I think it's way too early to say it's a hedge against inflation. I mean, it hasn't been around the block yet, and its volatility makes it problematic as a hedge against anything else.
Yeah, no, listen, I think you're let's debunk, even though I gave some supporting points, let's debunk the whole currency thing. It's not a currency. I know it is starting to become a means of transfer of wealth or value, right? And I wasn't joking when I said El Salvador has now, I think, approved it as an official means of uh, uh, transferring wealth, transferring assets. Right? I think they gave everybody in the country got given an account with $30 worth of Bitcoin in it, and said, okay, now you can use this if you want to go to the grocery store or whatever you want to do. Use this to buy it, and now you can transact that way. It's easier than moving money around, with normal means. And I didn't realize this till I heard the discussion about it. I guess there's 4 million people in El Salvador. Only a million plus, have bank accounts, but 3 million of them opened up this crypto account that they were given by the government and started using it. And so when it comes to, a way of, transferring value, it certainly seems like it's more adoptable. And it certainly seems easier because you just open your phone and you got it, right? And I know our banking industry is a little archaic in some ways, and there's a lot of reasons why. You want to have validation and verification, who's on a banking account, all those kinds of great things. But when you look at third world countries adopting this type of a vehicle as a means of transacting day-to-day activity, you can't say there's no value there in that aspect, right? Maybe not in the way that we think about a traditional investment or traditional currency, but there is value to certain parts of this world that it helps you kind of jumpstart and get caught up to the rest of the world. I'll use another example. When China was rolling out its cell service decades ago, right? They didn't go and lay lines and their telecom service and lay lines across the whole country and bury lines or on telephone lines. They just put up a bunch of cell towers and skipped the whole hardwire telephone line part, right? They just went right to the end answer. And so, because they had so much catching up to do. And so seems very much the same thing when it comes to making financial transactions. And so while we can, talk about it as, this trading asset, there are some uses across the world where I think we'll see more adoption than in the more developed nations, which is a little backwards.
Yeah, I mean, the interesting thing about the Salvadorian experiment, I'll call it, is so what happens if there is a material drop in the value of crypto and their purchasing power goes way down? Like, what does that mean long term? I don't know. And by the way, just because a country doesn't have to actually have their own currency, there are countries who use the dollar. You don't have to. I mean, we could tomorrow say we're not going to use dollars anymore. We're going to use Malaysian ringgits if we wanted to. But yeah, I think it is interesting. But by the way, by and large, though, the people who said Bitcoin was ridiculous and is going away, those people have been wrong, because despite all of this, it's been around for a while now. And as you've just laid out, there are countries who are adopting it. And so there might be something there, regardless of what anybody thinks.
I'm glad to hear you're willing to concede there might be something there to this crypto thing. That's great, Derek. It's a step in the right direction, I believe.
When we think about hedging, though, Jay, I mean, it's, to me, I mean, look, hedging, not every hedge, as we know, has, you could have, I hope this works hedges, and you could have hedges with legitimate, or let's say the ability to actually, put a floor in a portfolio. To me, having Bitcoin or owning, I mean, it's just like owning bonds or owning anything else. You're hoping that it works. And it's not unlike, I mean, look, 60-40 is hoping that there's no guarantee that bonds and stocks don't go down in the same year. Historically, bonds have gone up when stocks have gone down. So, but I think as a hedge, it's way too early and way too volatile.
Yeah, agreed. I don't think it should be considered that. It hasn't proved itself to be that. B, it seems to march to its own drum. I mean, a perfect example is there's so much headline risk, up or down, when it comes to Bitcoin that you can't count on, right? It's now illegal to own, hold, or mine Bitcoin in China, I believe. Guess what? That was a bad week for Bitcoin when that came out, right? Because there were more miners in China than anywhere else. They said, you can't even have this now. It's illegal to have it. You got to get rid of it all. So that's not great. That is, Obviously, it's not great for Bitcoin, but that is like when you have that kind of risk within your asset class and that's your hedge, it's a huge mistake. Yes, bonds have risk when it comes to what the Fed is doing, right? But there's a ton of volume and a ton of positions that are put on in stocks and bonds or even real estate, right? That no one single headline will break that asset class, right? But crypto absolutely carries this headline risk that's really kind of uncommon to anything else.
The other thing I'll ask, and I've been thinking about this recently, Jay, and it's the idea of the whole, everyone says, well, okay, maybe it's not a currency, but it's something, just an asset that will go up or down based upon supply and demand, like anything else. But then the idea that, blockchain is really where it's at. And I had somebody ask me a question. They said, Derek, I know the whole theory. I should be using Bitcoin and we should be using blockchain because then I can go back on a ledger. And the guy said to me, somebody can do that, but I can't. Like, what is the utility or the value of blockchain to the general person that's out there? And it is an interesting comment. Like, I have a small amount of crypto, and I know in theory, like I can go and look at some blockchain. I don't know how to do that, so I don't know. Maybe that's the value of that is overstated as yet. Maybe I'm wrong there, though, Jay.
Yeah, I listen. The blockchain is the real utility, and the crypto tokens are the payment for getting a dispersed support of it, right? If Bitcoin went down to $1 or $10, you would see a lot of people turn off their servers that are currently getting paid to maintain the blockchain, right? Bitcoin is obviously so big now that that's probably not going to happen. But in other cryptos and other blockchains, it's one of those things that that's your compensation, right? You get paid these tokens for leaving your computer on and letting it being used as part of the distributed data source. And so, I listen. I do believe there's real utility there. It isn't mature enough to handle any serious part of our economy, but I could see that you can use blockchain for some tracking of some financial transactions. Real estate is a good one, right? There's not so many real estate transactions that blockchain can't handle it. Blockchain can't handle stock trading yet. Blockchain can't handle, bond trading, anything like that that has so much activity. But it's not like everybody's buying and selling, a house intraday, right? That's not the way it works. And so you could start to keep records. It's an easier way of keeping records than traditional storage of deeds and titles. So like it just might be a better way to start to be integrated into that. But if you want to be somebody that wants to be a part of whatever blockchain that is, yeah, it's going to cost you time and money, and hopefully you get paid back by the cryptocurrency that ends up coming your way when you open up that account and do the support. So it's just a payment method, which is why there's some inherent value. I don't know what that number is. It's there's a point where there's a catastrophic decline in the value of that support that causes people to just leave, right? There can be a mass exodus when it comes to supporting that. And then, that opens up all sorts of questions that, okay, what's the long-term security here? But back to the whole blockchain, the concept and the utility of the blockchain, I absolutely think has value. It's, distributed data record keeping, and that should make things faster, and it should make it harder for fraud to be enacted, especially when you have large volume like Ethereum and Bitcoin.
The other thing, I think you mentioned it on one of your media appearances this week or last week, was the idea that volatility is being impacted by crypto in an indirect way. And that's because I think you mentioned this, Jay, maybe on Bloomberg or somewhere else, that some companies are converting their cash to cryptos. And so in an indirect way, it already is seeping into the S&P on a small level as of yet, right?
Absolutely. And I don't Tesla holds Bitcoin on their balance sheet. Micron is converting all of their, held cash to Bitcoin, right? So there's that adds volatility to the value of those companies, and the stock market is a reflection of that. At least their stock value. And so and these are not small companies I'm talking about, right? What's Tesla's like? What, the number 7, 8 company in the
Top
S&P. It might
10.
even be
Yeah, for
more.
sure.
Yeah, right.
Yeah.
So, the fact that part of their profitability is now tied to the value of the assets on their books, which includes Bitcoin, adds in risk to the S&P 500 from those companies. And so, it's part of the reason why I know we were having a conversation earlier, just, our investment committee, which you're a part of, like, hey, the VIX isn't going to go below 15 because there's some inherent volatility just waiting. We think crypto is one of those things. Obviously, what's going on with Fed and inflation is another one, and where the market is trading is another one. But all of those things being said, you have to just assume now that crypto has made its way into stock prices indirectly. And, it could even make its way in more directly with, the newly released ETFs. There's a handful of ETFs that are out there now that they're ETFs. They're not ETNs. They're not like Grayscale. They are, I think Valkyrie has one. And of course, ProShares has one. Those ETFs now are assets, right? They're not part of the S&P 500, but now it's, hey, this is a security, right? The SEC and FINRA have said this is a security. You can invest in this. And it's one of those things that as all of that seeps its way into the market, it's a new asset class that can cause risk that will ripple throughout the rest of the market. Let's just say an individual investor thinks, well, I really want to get behind Bitcoin, and they put half their money into this Bitcoin ETF, right? When that sells off, and gosh, let's hope they didn't even do it on margin, they're going to be forced to sell other things. And so, this is not, I'm not saying anything that's brand new, right? When there's a problem in one part of your portfolio, the way you pay for it is by selling the stuff that doesn't have a problem. And if that stocks, great, then it just gets reflected that way. So it is definitely seeping its way in, not only on balance sheets, but also in the trading of the individual investor. It's just seeping its way into the rest of the market. It's something we have to watch now.
It's reducing, those ETFs are reducing friction. So economics, we think about friction as an impediment or a barrier to something. And so Amazon reduced friction for buying things. You don't have to go in your car and go to the mall or even around the holidays. And Jay, you and I are familiar with was it Garden State Plaza and Paramus Park? I mean, you had to park in another state to get to the Garden State Plaza in New Jersey around the holidays. You had to park so far away. So I think that reducing friction, certainly making it easier for someone within their existing brokerage account to go and include that asset. I think it's going to bring marginal buyers or marginal people interested in that asset off the sidelines for sure.
Which will add to the volatility of their own portfolio.
Speaking of volatility, Jay, and putting aside the crypto discussion for now, although we'll probably most likely have more to say on that at a later date, the Fed announced a tapering. And so when we say taper, it doesn't mean that they're raising interest rates or they're eliminating all of their bond purchases, both in the MBS, mortgage-backed securities, and then treasuries. I believe they said it was a reduction of 10 billion a month in treasuries and 5 billion a month in MBS. So it's much like a government budget. It hasn't gone down, just reduced the amount of acceleration. Jay, I don't know if this is I tend to think it's less of a big deal based upon the size of the balance sheet now. Plus, they're doing so much. Well, actually, let me stop there and see if you have any thoughts around that.
Yeah, So I think this was pretty well communicated ahead of time. The market didn't seem to have a bad reaction to it at all. Um, Listen, rates going up, and although you're absolutely correct, tapering doesn't mean rates are going up. It just means they're going to be a little less dovish, a little less accommodative than they were in previous months. So this has been, and that's great. It just, by the way, they're still accommodating. They're still purchasing, right? They're still buying bonds to help spur, an economic recovery, right? It seems silly to say that considering where the market is, right? I think we touched another all-time high today. I think almost every day this past week we touched an all-time high. When you think about the taper aspect, it is a precursor to raising rates, right? You wouldn't be, tapering, or sorry, you wouldn't be buying bonds at the same time that you are raising rates, right? It seems like, don't do one and then offset it the other way. So you kind of got to, taper down, reduce down your purchases down to nothing, and then you could start raising rates. That seems to be what's been communicated. I don't sit in the Fed, so I don't know exactly what they're going to do. But what they've told us is we're going to taper first. We're not at the point of talking about raising rates. But this first step was well received by the market, I believe, and it was well communicated ahead of time.
The other thing, this is one of those things that I think I'm surprised no one's talking about, and it's the reverse, the Fed's activity in the overnight reverse repo market. For anyone, I'll put a link to an episode I did on that. People seem to like that one, but basically, it's you have all these money market funds who can't hold cash, so they got to go out and buy typically really short duration paper, like we're talking in the bill market with treasuries. And there was such demand that the Fed saw that rates actually went negative on the really short end of the curve for a small amount of time. And so they're doing these overnight reverse repos, and I think they're at 8 basis points right now. So they sort of set a floor in the short end market. Jay, they were at 1.3 trillion, I think, the other day. So I bring that up because I feel like there's a lot of demand still for really short-term paper. And so even though the Fed is dialing back a little bit on their monthly purchases, I mean, there's plenty of demand on the short end. So even if the Treasury is issuing more bills, I feel like that will be scooped up. But look, what the heck do I know, right? I'm just
It almost seems sometimes that the reverse repo rate is its own little universe, right? And I understand its importance, but it hasn't had an impact, even though we're at kind of historic levels here. Past there's a T now involved with trillions. That's never happened before. It hasn't, to me, it hasn't been the thing that has been pushing, say, the 10-year price around very much. I think it's something to watch for. The fact that they have to continue to do that. It also might have to do with the fact, Derek, that there's just so much more money out there, right? I mean, connect for me like the M2 money supply, right, which is kind of how much people have in bank accounts or brokerages with the repo market. Like, do you see a relationship there that, as the money supply increases, that reverse repo market's got to continue to rise as well?
Yeah, I mean, we don't want to. I need 5 hours to really disentangle all this, but in in 10
Let's
seconds,
not do
yeah,
that. 10
yeah,
seconds.
Jay, yeah, yeah. Our Netherlands listeners and Denmark listeners would all be gone at this point, but
If we haven't lost them
no,
yet, we will soon.
but no, I think you're right on a high level. Yeah, I mean, if there's more money, and especially in money markets, right, and some of those asset classes, yeah, I mean, there's more money hunting for a home, which says in theory, it tells me there's a shortage of treasuries, especially on the short end. So yeah, Jay, I think that's right, and yeah,
So let's tie it back to the tapering then, right? So they have to stop buying, right? I mean, they're essentially buying up, right, the assets that are out there. So as they come off, what the logical, to me, what's logical, and this is not what's happened in the market, but what happens is, hey, as you lose your biggest buyer of these assets, you have, the market should be it either needs to step up or the price is going to go down, right? If people are regularly selling here because they're forced to be engaged in the bond market, if you're regularly selling to the Fed and now they're no longer there, right? Wouldn't you think that bonds themselves would go down a little bit, right? Now that hasn't been the case, but maybe talk us through a little bit about when the Fed is buying bonds, how that helps support bond prices. Maybe that's just way too obvious already, but maybe like dig into that just for a second, Derek.
yeah. Well, I think on the high level, right, it's supply and demand. So. And bonds, as we've talked about before, have an inverse relationship. It's the seesaw. So bond prices up, yields down. Bond prices down, yields up. And the idea is if you have a lot of buying of bonds, that should push bonds higher, which pushes yields lower. And so the general feeling is if the Fed steps back from that and you take away a marginal buyer or a piece of the marginal buyers in the market for those bonds, then demand goes down a little bit and yields should go up because prices should fall. But I think what I'm seeing is that on especially, and this is really the short end now. And it doesn't, the Treasury can issue 3-month bills, they can issue 1 year, bills, they can issue short-term bonds. But I think on the very short end, there is more demand than there is supply. And I think that's why we've seen that repo market. If not for the repo market, I think rates would be much, they'd be negative on the very, very short end. But look, I mean, I think thinking about the markets and thinking about bonds, none of what I'm saying, or certainly I'll speak for you for a second, or you are speculating about, we are historians of the market and we have a very big interest in the market. We have opinions, but none of this really impacts anything we're doing, let's say, with strategies we're running with real money. So a lot of this is conjecture. And I'll be honest, I mean, my thought is that historically, rates rise into the expectation of announcement of a taper, and then they start to come down once the taper happens. Kind of like earnings, Jay, where you sell the rumor, buy the news. I'm totally getting that wrong. But
it's buy the rumor, sell the news.
Yeah,
right?
There you go. I knew.
Yeah, you got it. But that's actually what has happened, right? Rates ran up leading into the Fed meeting. I don't know if you see this as we're recording this podcast right now. The 10-year's at 1.45, 1.45%. That is down significantly from where it was just 2 weeks ago. And I believe you lost a little bit of a wager where we saw almost 1.7%, right? So your point of, hey, when you're leading in, they run up, you come out of these kind of announcements, they pull back a little bit on yields. However, I will add to your point of how, this is more conjecture, but it does matter how we build portfolios to clients, right? For clients. Like today, someone walks in your door, what percentage are you allocating towards bonds, even if it's in investment grade bonds? How much are you putting in that kind of an allocation today? Virtually nothing, right? I don't want to, maybe I should speak for you. I hope that's the case. Virtually nothing.
Yeah.
Right?
I mean, agree. Go ahead, Jay, and then
there's some scenarios where it's appropriate, but with the prospect of rates normalizing, which in this case means higher, it's hard to invest in a long period of time in bonds. And so while this is an interesting discussion, it does impact the way that you and I build portfolios, the way we manage our strategies. We don't really want a lot of straight up bond exposure, right? We need alternatives for the role that bonds used to play. Without pitching our stuff too hard, my apologies to anybody that hasn't heard it before or has heard it over time. There's a better way to manage risk than using bonds. There are other ways of generating income than using bonds. Period.
No. Yeah, no, I agree. And I think it's one of the reasons why we use synthetics when it comes to the bond market. We're, synthetically creating the income, but limiting the risk. I agree. I mean, because when you look at where yields are today, let's say if you were going to buy that 10-year treasury you just quoted me, next 10 years, you're going to get 1.45%. Well, let's assume for a second, and that's maybe a discussion for another day, but inflation stays above 1.45% per year. You are losing purchasing power each and every year you hold that bond. And the risk to the upside on that bond, if rates rise materially, is, for every 100 basis point move, you would expect in that bond to lose, roughly 8.5, 8.9%, maybe 9%. The calculation is, I'm doing a calculation in my head. But yeah, and if rates go from 1.45 to 3.45, I mean, that would be on a standard deviation basis. That type of reduction in the price of that 10-year would be great. And at the same time, as we
great
know,
in a bad way. Great in a bad way.
Yeah, like it would
high
be
magnitude, bad way.
It would be a great big deal. How's that?
There you go.
But like, is there a scenario, and I can give you one, but is there a scenario where rates go to, negative 65 basis points on the 10-year? I mean, it's, that's sort of what you would need for the same magnitude of, you actually need a little bit less, but that's a convexity thing. But yeah, to your point, Jay, I mean, it's bonds, the risk is to upside in rates, the benefit of a reduction in rates is not as great, I would say, right now.
And let's say it takes a long time for the bonds to actually normalize and go up, which seems to be the most likely way of being wrong in the thesis that rates are going up, right? So if you think rates are going to go up over the next 2, 3, 4, 5 years, and you're wrong, the most likely result is that they were flat, right? Going negative seems extremely unlikely in the U.S. And so I understand why it is in other economies, but in the United States that seems extremely unlikely. So the risk of being, what is the risk here of being wrong? It's continuing to lose money against inflation. Fine, maybe your bond didn't lose value and you're still at the 145 in 3 years from now, right? But you still lost value against inflation, right? Your real yield has turned out to be a problem for you, right? You've lost, your buying power has been reduced. And so it's, the thesis is, well, bonds are going to lose value, so that's bad. Or if, the most likely, wrong answer against that is that you'll still lose value because you're only getting 1.45% payment on that 10-year bond. Also seems like a bad idea, right? So it's, unless there's rare situations, it's not our go-to solution for investors that have a goal over the next 5 to 10 years.
I think there's been some academic papers, and if I don't know if I'll find it in time to put it in the show notes, but I think over a long period of time, your total return on the holding period of a bond is pretty much whatever the yield to maturity is when you buy it. So if the yield to maturity is 145 for the next 10 years, historically, according to some academics, that's about what you would get on an annualized basis. And to your point, unless inflation dips below 145, that is a negative real return. On the pro side of bonds, because I want to be clear, I'm not saying, neither of us is saying, take a short position on bonds, take a long position on bonds. You got to think about the risk. But look, bonds worked in 2020, 2020, yeah, 2020, because rates dropped so far. So they worked. And, those who still sing the praises of the 60-40 portfolio could point to that. Jay, transitioning though to the other news of the week, a little bit more on inflation and a little bit more on wage growth. We did have I think it's characterized as a positive jobs number today, meaning more jobs were created. And we saw some wage growth. September, I forget, it was millions of people came off the rolls of the enhanced unemployment. So maybe that was what was seeping into this number. It took a little time to get folks off the sidelines, but I don't know. I mean, I know you kind of laughed a little bit when I said it was a positive in some ways, negative in others, right?
Yeah, it is positive. I mean, it certainly beat expectations, having, I think it was 531,000 new jobs created in the month of October. That was obviously a positive thing. The little bit of the negative was, well, I guess it's good for the workers. Hourly earnings went up a little bit, right? We saw a tick up in that, which is, probably where we'll lead to, because you started with inflation. And productivity, which is a number we got 2 days ago, was really, poor, right? It cost more to produce what we were producing, more, I guess it was October. It cost more to produce goods in October than it did in the previous months, by something like 8%. And so there are good and bad pieces of this. Generally speaking, though, the delay in the numbers when it comes out for this, for the jobs number, is kind of significant, right? I mean, it doesn't measure all of October. And I think you're accurate to point out that in September, a lot of folks rolled off of the government support that they might have been getting with stimulus checks and those types of things. I think that is what we're seeing right now, just some of that rolling off. People had to go back to work. But there's still a lot of job openings still left to fill to get back to pre-COVID levels, right? Something like 4 million openings still, are out there that just to get us back to that point. So, all that being said, I think generally the market is accepting this as, a good number. But I don't think we were all that surprised by it, right? Is that fair to say?
I don't think we should be surprised by it, given the change in the government programs, right? I mean, it just goes to, if you don't have that same amount of money coming in anymore, wouldn't the next step at some point either say, okay, I've got to go take one of these positions, or my savings is running out from all the excess stuff. But I think the productivity thing is really interesting. It didn't get talked about. And so, by the way, productivity, for anyone in the audience who's unfamiliar with that, it's the technical economics, quote unquote, definition. It measures output per unit of input, such as labor, capital, or other resources. So it's, uh, and another way to look at it is comparing GDP to hours worked. So it's like you work an hour, like what are you producing? Oh, okay. Last month you produced X and this month it's down. And that's what happened, Jay. I don't think that was talked about enough, to be honest with you.
I agree. And, there could be a couple of things that it means. The first thing could be like, hey, we had a bunch of new people come take up jobs, and people that start a job aren't as productive as people that have been in a job for 3 or 4 years. It could be that. Or it could be it's just a little more expensive now to produce what we used to produce because wages are also a little higher. It could mean that as well. So there's a lot of different ways to kind of read into it. I was surprised at the lack of kind of attention that it got. Of course, it is not. That number seems to move quite a bit, and it's more of you got to watch for the trend on this. But it was kind of 8% higher. Productivity costs month over month. Has to take you back a little bit.
The other thing I think I'll mention quickly is, if I was grabbing the back of an envelope or a napkin and explaining what's something to watch for to see if inflation is going to continue, I would look at what are people making versus, or what's the growth in wages versus the growth or the inflation number. And if nothing else, you would say, okay, if people keep making more than prices have gone up, demand should continue. But if wages start to not keep up with the pace of inflation, you would say, well, at some point, inflation will wane. And I think you're right, Jay, to look at that wage growth, because it has been moving higher, and I think it's outpacing inflation of late. I could be wrong on that, but that would sort of go support the narrative of, look, I mean, yeah, prices are higher, but people have more money, maybe.
I think you said it. I think you got it. I would say in general, it's good more people are going back to work. I think in general, it's good that people are, getting employed. There certainly doesn't seem to be a lack of job opportunities, but I do think it comes down to the opportunity you want versus the one you take. I think because folks have a little more savings these days, they may be holding out for a better job. They're maybe using this as an opportunity to kind of move up in the skill set, right? And so that may be another reason why it's taking so long for all of these job openings to get filled, because maybe people are holding out for a better job, right? And so I think there's some of that that's going on. The other thing I'll throw out there, somebody, I don't know who I was talking to. Someone said, "Well, I've kind of become my own, my own boss, right? I'm kind of doing my own stuff. I've left, the corporate jobs and I've started my own little business, right? I think we've seen some of that happen as well. Less reliance on the companies that cut you because of COVID and more reliance on yourself. As two, entrepreneurial guys, I think we can appreciate that. I think there's some of that going on here as well, especially with a lot of the technology solutions and the advancement that we've seen, certainly in the adoption of technology solutions to make it easier for the individual to launch their own business. So, I think some of that will start to play itself out as well, Derek. Right? So either improving who you work for or working for yourself.
That's an excellent point, and people should remember, this economic data and the employment numbers specifically, it's sort of survey and sample data that gets extrapolated out. And I'm glad you said that, because I've had people I've talked to as well say, look, I'm trying to start a business or something. And is that really captured? Like, are those people considered unemployed, or are they considered working? The reality is, and don't get me started about unemployment numbers, but if somebody stops looking for long enough for a job, they're no longer considered unemployed based upon the headline number. You have to be out of work and be actively looking for work to be in that numerator denominator type thing. But
right.
Anyway, last thing, Jay, I thought I'd bring up is interesting. The market crested. Did we really crest 4,700 today? I guess we did, didn't we?
Yeah, we did. 47.18 was the top today.
47.18.
Friday, November 5th.
Yeah. So I always go back to, if you just did, and I'm not holding, there's nothing against CNBC because they all do it. But if you went back and you click through, you did a random search for a random week over the last 10 years or last whatever, you would find some article that says, hey, we're on the verge of a major crash. Sell out of everything. Buy, soap and soup and build a bunker. And they've all been wrong. I mean, it time and time again, like, I feel like that advice is not great advice. And I'm just going to say,
it's hard for that
right?
to be right when just generally, I mean, yes, but that sells eyeballs and earlobes. What do you say when you say
Sells,
ears? People
attracts eye lobes, attracts ears and eyes.
Yeah, thanks for correcting me. That's good. So, but you're right. And when, if their ratings are higher, when people are fearful, that people are like, I need information. When portfolios are at all-time highs, are you tuned in, besides, you and I, are you tuned in to watching what's going on in the financial markets? No, you're a little more complacent there, and you're facing the other troubles you have in your life. So, you're right, Derek. It's almost irresponsible, but this is not something new that you're pointing out. This has always been the case, and it's also the case why we've always said stay invested. Right? I was in a discussion with some folks yesterday, and if you were trying to market time and you happen to miss the worst 2 days of the year each year over the last 10 years or 20 years, your returns would be negative in the greatest bull market in history, right? So market timing is hard. Oh, and by the way, when the best days of the year are, Derek, most of the time?
I know.
Right after the worst days, right? So it's when everybody's running for cover and selling their stuff is exactly the next day is usually the best one, right? And not usually, but it's a high percentage of the time it's in the top. It's in the top 5 days of the year, and so it's just one of those things that for us it's always been the exact opposite of what you're hearing in the media about run for cover. You should be careful. Listen, those guys are going to be right one of these days, but they've been wrong up until this point. And gosh, I don't want to say it's not rocket science. It's not the hardest thing in the world to realize that if you could stay invested over time, the market rewards you for doing that. Now, I don't think, Derek, we would say, you should always just be in the most volatile thing you could be in and go. We're all about limiting risk and being protected, which gives you the wherewithal to stay invested. But, if you had to pick one trend, the market goes up or the market goes down, and you had to guess which one of those two sides to be on, you should be on the side that the market goes up more often than it goes down.
If markets really were random, like some books have been written on, when you did a random price generator, there would be every bit as chance to go down than go up. But if you want to get your lines to look like the market, you have to program in an upward bias. And markets are price isn't necessarily random like that. There is an upward bias. And yeah, I mean, to me, it's just buy and hedge. Imagine that.
Imagine.
Good book.
What a
good
concept.
book, by the way. Good book,
Thank
by
you.
the way.
Thank you. You could find it on Amazon. It's a great Thanksgiving gift if you're thinking about giving it.
Yeah.
As is the broken pie chart.
Wonderful. Yeah, well, this is great. You show up to somebody's house, bring the appetizers and some books over. They'll appreciate it. All right.
They will. Somebody last night asked me for my book randomly.
Nice.
You could go buy it on Amazon. It's right there. You could do it on your phone. There's a Kindle version. Knock yourself out.
Well, before we leave, I'll just clean up for Netherlands and Denmark, right, are two different countries.
They are.
They're both in Europe. Denmark is in the Baltic Sea, while the Netherlands lies to the west of Denmark. Netherlands, I believe, is synonymous with Holland, but and Copenhagen is in Denmark. Copenhagen's in Denmark.
True. It's true. I've been to Copenhagen.
Yeah.
Wonderful
Where
city.
Holland or the Netherlands has Amsterdam as its capital city. So there you go. But yes, we do have listeners from the Netherlands and Denmark as well, and we appreciate those as well as others. Finally, I'll just mention I have yet to get a listener from the country of Gibraltar, which is it's not. I don't know, there's a relationship with England, but if you are from Gibraltar and are listening, send me a note and I will send you a signed book. But it's the never-ending plea for the Gibraltarians to come through for the Broken Pie Chart podcast, Jay.
It's an important demographic, Derek, and I think it's worth the regular communication.
I agree. All right, Jay. Well, thanks for coming on again, and I know we'll have you back on shortly, if not before then. We seem to always get you on the odd numbers. Like you're never at maybe episode 150 we'll actually schedule, which would be about 8 weeks from now. So that would be end of year, beginning of year, but we'll have you on before then. So Jay, thanks again for the time and appreciate the conversation.
Always great to be here, Derek. Thanks so much.